When the surrender etc. happens at the very early duration, very early stage of this policy. Typically, if you see the highest rate of surrenders or discontinuance, it happens during the first 5 years of a policy.
Right.
So at that time, if you are planning to provide more benefits, higher benefits to the policyholder, your affordability towards expenses and towards paying the other, later duration survival benefits or maturity benefits, it reduces. But overall, I find whatever is my sense is that mostly companies will try to adjust it by reducing expenses, which happens at their own.
Right.
And also to some extent it may impact the later duration survival benefits or maturity benefits.
The Insurance Regulatory and Development Authority of India (IRDAI) on December 12, 2023 released an exposure draft proposing a host of changes. Among various other changes suggested is the measure proposed to increase the surrender value of non-linked policies. The 28-page document also lists down various other proposals and has requested all stakeholders to forward their comments and suggestions by 3rd Jan 2024. The main objective of the proposed draft regulations is to facilitate insurers to respond faster to the emerging market needs, to promote ease of doing business, to improve insurance penetration, to protect the policyholders' interests by enabling insurers to adopt good governance while deciding and pricing the products. The aim also is to enable insurers to ensure sound and responsive management practices for effective oversight and adequate due diligence with regard to insurance products, including innovative products considering the interests of policyholders. But what are the regulations? Why is it being proposed, and how will this benefit policyholders? You're listening to the brand new episode of Insuring India, a podcast by Digit Insurance, and I am your host Sabri Saran. Stay with me for this wonderful conversation with Sabyasachi Sarkar, appointed Actuary of Go Digit Life Insurance, as we dig deeper into the IRDAI's new exposure draft and take you through the intricacies of the proposed changes. How are things structured currently? Why are the changes being proposed, and how will it benefit especially you, the policyholder? Listen in. Sabya, thank you so much for joining us on this podcast.
Thank you, Sabri. Thanks for having me. Glad to be here.
So Sabya, as I mentioned in my intro as well, the plan is to discuss the exposure draft released by the IRDA on December 12. For our listeners who might not know how insurance industry works, can you quickly explain what is an exposure draft and what is typically the purpose of it?
Yeah, certainly. So exposure draft is basically before introducing any regulations which will be applicable by the IRDA, that is our regulator, insurance regulator across the industry. They want to have the public opinion, particularly the expert opinion. There are several actuaries, our actuarial institute and the other institute. They want to have how people are thinking over it. It is, you can say, it is a mutual discussion stage where we can suggest any change. So through exposure draft, basically the regulator put into make it available to all how they are thinking about the current or the future insurance industry to move towards, and accordingly they prepare an exposure draft which they circulate, and sometimes they also frame an expert committee under guidance or under the purview of the regulator itself. They come up with a draft. This is what the suggestion they provide, that is what I want to bring, I want to take our insurance industry towards this line. This is the exposure draft.
Right.
And after issuing that exposure draft, generally they give some time for the common people, including all, to give their opinion or how they are thinking about this exposure draft which has been issued, and where if they have any objection or any alternative thinking on it, with rationale, everybody needs to get back to IRDA again. After they receive all the opinion, all the comments, all the objections to the exposure draft, they again reassemble and they again go through each and every one of these. And if they feel that something is required to be changed in the exposure draft itself,
Right.
they make that change, and certainly after that it goes for notification, and once notified it becomes the regulation of the land. Just I am giving you one example. Suppose in 2015 there was one minimum surrender value regulation which came into the market.
Right.
So at the exposure stage itself, that line was omitted ki whatever will be the premium, percentage of that will be the guaranteed surrender value.
Right.
But they did not consider ki if any survival benefit already has been paid. So they were not, that was not considered into the exposure.
Right.
And there were several comments made, and one comment went to the then Exide Life, which includes ki bhai, you have to reduce it to the extent of any survival benefit which has been already paid. So in the final stage it was included, and then finally it was not. So this is basically the life stage of an exposure draft. So finally, with due course of time, the exposure draft will be converted into the regulation with necessary changes, amendment or addition, whatever is as per the market fit.
Right, understood. So Sabya, I want to first talk about the changes proposed in lowering surrender changes for non-par life insurance products, because in this particular exposure draft that seems to be the talk of the town. And I also want to talk about this extensively. So can you explain what are the changes proposed, and if you can also talk about how the surrender charges are structured currently?
Yeah, so basically, insurance is a little complicated financial product, and particularly when it is coming under non-linked platform, there everything is embedded into one packet. So segregating what is the risk part, what is the savings part, etc. are too difficult and may not be feasible at any time.
Right.
Our all current act regulation also recognizes that. That is why you will find the traditional product, the GST rule is different. It is not 18% of the whole premium whenever there is any savings component.
Right.
Because they recognize some portion of the premium is for the savings component and some portion is for the risk part, that is the life cover or whatever contingency are being covered through that product.
Right.
So basically this current surrender change proposed, whatever has been proposed to the exposure draft, I find it as if that is a step towards segregating that premium into these two parts.
Right.
That is, each and every premium for a particular policy, traditional policy which is not under linked platform, they are trying to segregate under risk and under non-risk. Non-risk means saving portion. And as rightly said, they have mentioned that naturally people should not expect that something will be debited or something will be deducted in the name of any charge out of their savings component, out of the savings component of that premium.
Right.
Naturally, some in that line, if you think for an unit link platform, there whatever premium is allocated to the unit fund, that is the savings component.
Correct.
And naturally, even there also some portion is subject to surrender charge, but that is a very low portion, low amount which is to be charged towards any early surrender. Naturally, whenever any surrender happens, it is there are several impact which happens to insurance companies. And also it happens to the insured, that is the life assured who are taking the policy.
Right.
So current regulation, I will say the existing regulation with respect to this surrender charge or anything for traditional product, possibly the angle of view or the viewpoint of the individual customers were not considered in such a favorable manner, which they have tried to make it. And they are telling ki indirectly, although indirectly, the name they have not added, they are added a different nomenclature like threshold premium or something.
Right.
So any premium up to the threshold, it is similar to, at least if not equal, it is similar to the savings component of the premium, which has been given, which has been paid by the policyholder concerned, and the balance part is the pure insurance part.
Right.
Typically, in any insurance product, particularly life insurance product, there are two components which are linked to it, two parts which are linked to it.
Right.
One is the pure insurance, where it depends upon contingency. If you die, if you have the accidental death, if you have some illness, etc., long term.
Right.
So that is the contingency premium. And other than that, which is the savings. Traditionally in India, historically, if you see, life insurance, basically the savings part has become an integral part. Most of the policies it offers type. Earlier days it was similar to any endowment policy. That is the benefit if you die or survive type.
Right.
So that was the traditional platform, very common in India. So in that line, even today, somewhere between 2010, before 2010, unit link was very popular. But again, this space is growing. So I think it is a very timely move from our regulator side, and they are practically trying to keep the interest of the particular policyholder who are practically staying with us, who are practically choosing the insurance product, traditional insurance product, which is not purely the risk product, which is risk and savings component, all are put together.
Right.
They are trying to keep the interest or uphold the interest of that policyholders, which was not there in this form earlier.
Understood. But I also want to understand, Sabya, like, is it good news for policyholders? You spoke about the surrender charge that existed earlier. So, is it not likely to encourage people to surrender the policy?
Yeah, that is a very relevant question. Definitely, what I believe personally, it may not be the same belief for everyone. What I believe, surrendering happens in two forms. One mostly is the need changes during the time of the policy time, during the policy tenure. The need of the customer based on which the policy was taken, that changes.
Correct.
So he finds no interest to continue this policy. This is one. And second also happens it is the unaffordability part.
Right.
That is the premium what he promised for a 10-year policy premium paying term, which he one or two premium he might have given very easily, and after that he finds it becomes unaffordable. And in our current regulation, practically there is very little scope of changing the premium as per his required, as per his
Correct.
revised affordability. So
Yeah.
that is also one thing. And thirdly, it is definitely the follow-up which happens. But that part has come out to be almost negligible in the recent years, where all the insurance companies, I think, they actively follow up for any renewal premium collection, etc. So if you exclude the last point, that is the follow-up issue, which has broadly been addressed now, which I believe.
Right.
Other than that, it remains the affordability, and it remains the changing the need, etc. But on the other side, when a policy is getting surrendered, there is a loss to the financial companies. Ultimately, whatever is the premium received, that amount is being distributed among the policyholders in form of various benefits, like death benefit, like surrender benefit, like survival benefit,
Right.
and the related expenses incurred by the company, which includes commission, etc. as well.
Right.
Now the total amount of premium remains the same. Now it is the matter how you are structuring the benefit. If you give more death benefit, if you give more survival benefit, naturally your capacity to afford higher surrender benefit reduces.
Correct.
And vice versa. So I think overall it will not change much. But definitely when the surrender, etc. happens at the very early duration, very early stage of this policy. Typically, if you see the highest rate of surrenders or discontinuance, it happens during the first 5 years of a policy.
Right.
So at that time, if you are planning to provide more benefits, higher benefits to the policyholder, your affordability towards expenses and towards paying the later duration survival benefits or maturity benefits, it reduces. But overall, I find whatever is my sense is that mostly companies will try to adjust it by reducing expenses, which happens at their own,
Right.
and Also, to some extent, it may impact the latter duration survival benefits or maturity benefits, unless the reality comes into it becomes a reality. Unless we find any new product which are compliant to this new product regulations, it is very difficult to comment with 100% accuracy or surety at this. So let us also see. Let us also try to see what happens subsequently. And I feel whatever happens, policyholders will benefit out of it.
Right, understood. We have actually covered the whole surrender charges proposal in detail, but there are actually a lot of other things mentioned in the exposure draft as well. And I'm not sure if this is a new concept or it existed before, but there is also mention of having a new index linked insurance product. So, can you explain what this is, and is it similar to index funds that we know of in mutual funds?
Yeah, Sabri, it is to some extent similar, but not exactly. Like, let me give you the current position and as well as what is proposed under index link fund.
Right.
Let us say a current and traditional non-participating product where everything is guaranteed.
Right.
Whatever happens, whatever be the market performance, whatever be the performance of the insurance company, whatever guarantee which has been made to the particular policyholder at the time of issuance, it has to be fulfilled. There is no deviation out from that.
Correct, yeah.
The second version, I think you can understand, that is the unit link. Whatever money is the premium which are being paid by the policyholder, net of allocation charge, the remaining money is invested into various funds, unit funds created by the company. And as per the market performance, and not market, as per the performance of those funds which have been created by the company, it moves.
Correct, yeah.
Whatever will be the benefit, and but mostly it is the survival benefits, and sometimes some death benefit also, or the contingency benefits are also linked to it.
Right.
And if you see, another thing is the participating product concept. There also it is in between these two, neither 100% guaranteed, not fully linked with the internal investment unit link investment funds which have been created. It is in between something, these two. You can say it is some blend between these two concepts, where policyholder generally they don't have any downside risk, but a limited upside potential they enjoy through the participating fund. Now this index link product, it is a new concept which I believe has been brought into this regulation, again in this exposure draft. It is basically telling how the fund will perform, how your savings component, particularly the savings component, how it will perform in future.
Right.
It is not mandatory that insurance companies has to separately set up this fund which will track this thing, which will track the particular index. Suppose if it is a Nifty,
Right.
if some company is telling your maturity value growth or the growth of your premium will be say 60% of your Nifty growth.
Right.
So the savings component, that is the savings component of it will grow with an 60%, it will track 60% of the index link fund. It may not be 100%, percentage can vary over this, but it is not fully like guaranteed, neither it is fully like what we discussed under unit link platform. It is solely dependent upon the performance of your internal fund. So for unit link fund, it is a separate fund has to be set up, and whatever is the fund investment guidelines is decided of that fund, all the policyholders who are investing into that particular unit link fund, they will get that benefit. Here it is not mandatory you have to set up the separate fund, but you have to give the guarantee how your future savings component, future survival benefits, etc., how it will perform. Right. So that is called the index link, and you have to link it with an external index.
Right.
Like unit link, it is linked to our internal index.
Correct.
Like that, it has to be linked with some external index, and it may not be 100% of that index. It can be various percentage as per the product you are choosing. And the onus is lying to the insurance companies. They have to manage their investment and all other risks, so that tracking or the whatever has been guaranteed, promised benefit which has been guaranteed, that they are able to justify, they are able to comply with those guarantees which has been provided.
I think I've understood the concept behind it, and I think it's a great product. I think it will be interesting to see how the actual product pans out.
Yeah. It is basically, the risk is also not to that extent of a guaranteed traditional product. Here, all the risks are lying with the company here.
Correct.
Unit link, practically all the investment risk are borne by the particular customer, by the particular policyholders. They are bearing, as an insurance company, they don't bear any risk there. But this index link fund is somewhere in between. You can assume safely.
Right, understood. Sabya, I also want to talk about the minimum sum assured on death being reduced for 50 years and above from 7 times that existed earlier to 5 times of the annual premium. So I actually just want to understand from you, what is the thought behind this and how will this actually benefit a senior person who's 50 and above?
Yeah, that's a very relevant question at this point of time. If you see a particular life stage of a person, if you see after crossing the age 80, etc., generally the financial stability you should expect higher than at 25 or early 30s of a particular person. So there, with the given financial stability, the basic requirement of buying an insurance is heavily, more weighted towards the savings component. Yes, I want to have some life cover also for the elder person, like say 50 or 55. He wants a cover, but by the time most of his personal liabilities towards his family, etc., it is somehow or other it has been taken care of.
Right.
So, but the need for savings, and particularly when this pension market in India, it is not so common or so widespread. Naturally, all the people in our country beyond 50 years, generally they start thinking on the savings component heavily, more with giving a more weightage, where they find the savings part is more important, possibly due to in their future retired life, etc.
Right.
Now, as I told, ultimately the total affordability of total benefit which an insurance company can afford goes in 3 forms. One is death, one is survival, one is maturity.
Correct.
So the total amount which he can provide, it will be among these 3, it will be distributed. Now, if you reduce the death benefit component, that means the benefit what you will be giving in towards death benefit, if you reduce that, naturally the capacity to provide survival benefit or maturity benefit, it will increase. So basically, it is more designed towards addressing the need for the savings part. It is not the risk part. Risk part, the requirement is reduced, and it is being compensated or offsetted by the higher savings component part, that is the investment requirement. Right. And the other relevant part is also where it is coming. Now, in the last, Income Tax Act, there also, if any policy premium exceeds 5 lakh, naturally there is no rebate on the maturity benefit in terms of income tax, etc., which were otherwise earlier there. So basically, I will say this is a flexibility which has been given to the concerned policyholder by our regulator. They are trying, if you don't require that much of life cover, means if your need for pure life insurance has reduced, this particular provision will allow the insurance company to design a product where the need of insurance or the proportion of benefit which going to the pure life cover insurance part, it will reduce, and it will have a matching increase in the survival benefit or to the savings component of the particular policy, which I think is a good move, because if that tax benefit also is a very big thing for all insurance product. Right. But anyhow, beyond 5 lakh, it is not there. And also the need for tax, etc., that is more relevant at the younger ages. So I think taking into consideration these aspects, the IRDA or our regulator has tried to be flexible, so that the changing policyholder needs can be addressed in a more better form.
Understood. I think sounds more logical also. Sabya, there are also changes suggested to micro insurance products. And I'll be honest, I am only starting to learn things about insurance. And honestly, I did read the changes, but I don't think I also fully understood it. So, can you first explain to our listeners, and especially for me, what micro insurance is first? And then, if you can take us through the changes that have been proposed in it?
Yeah. So basically, micro insurance. Just let me try to give some background. Life insurance particularly, it is little more costly manner, or the related associated expenses are little higher than any general insurance companies.
Correct.
Because here as I told, it is not only the pure insurance plus investment. Both the components are plays a role here. So basically, apart from the pure insurance part, you have to manage the investment part also, and to manage it you have to have a very robust system of controlling everything, starting from risk management to all operational aspects.
Correct.
So naturally the level of expenses are little higher in a life insurance and than any other insurance companies. If you see, that is the, even if you see the minimum capital requirement regulations, etc., they also recognizes it. The minimum capital requirement for a life insurance company is higher than the other insurance companies.
Right.
So when your, I will say, overhead and other expenses increases, naturally you cannot afford to allow product with a small ticket size, because your fixed cost will not be recovered from a small ticket size, etc. So that is why in our country, if you see, given the level of income in our country, etc., a substantial portion of our population, they were not included into the life insurance coverage. That is the situation which was there earlier, I will say early 2000 or so.
Right.
That was the situation, because insurance was limited to the only affluent section of the society. Broadly, you can say higher income level of the society, because the small ticket size policies were not feasible at that time.
Right.
And there were capital requirements, solvency requirements. There were many other parts which were imposed by the regulatory side also to address this higher risk. So the cost ultimately was increased.
Right.
Now in early 2000 period, our regulator also came through this concept. Basically, it is the main objective is to allow or to include those section of the society into the umbrella of life insurance. So that is the micro insurance, where you will be allowed to have products which are small ticket size, where benefit will be small. Naturally, you don't expect the higher section of the society will be included there. Like for example, right now the limit is 2 lakh sum assured.
Right.
So the contingency benefit will be limited to 2 lakh. So with that, this micro insurance concept works, and naturally, with the encouragement of the regulator, all the companies are encouraged to design the product to address the micro insurance. Maybe at standalone basis, the policies will be difficult to sustain or to justify the overhead cost of the company. But collectively, if you think, most of the portions are being covered there, and our expense of management regulations also allow for some relaxation, and other regulations also allow for some relaxation, so that the insurance can be offered at a lower cost or lower cheap rate, like that.
Right.
So broadly, if you see, this is the micro insurance area. Earlier also micro insurance areas were there. It mid 2000 actually it came into Indian context. But currently what has been changed, the major thing is that it has changed the distribution type. Who can distribute, how it can be distributed. Some relaxation has been given, because the insurance companies, particularly the life insurance companies, a significant portion goes through the distribution, towards the distribution cost.
Right.
So if you can ease the distribution, like one example I can give you, that is PMJJBY, Pradhan Mantri Bima Yojana, which has come into place. They are also at very cheap rate, at very low underwriting cost, etc. It could be afforded by the insurance companies, and definitely it was a success, because the government actively participated into it, and the government encouraged those section or those through various channel like banks, etc., bank, post office, etc.,
Right.
to so that the scope of the insurance increases.
Correct.
Now I think our insurance penetration has increased to a great extent simply through the usage of microinsurance. And current the regulation that what the exposure draft which has come, it has simply broadened little the scope of the microinsurance little bit, and particularly it has tried to even simplify or ease the distribution portion. So once this regulation is notified, that is when it becomes a regulation, real regulation, then I am expecting to see few new innovative microinsurance product also which will be there included in the market and available in the market.
Got it. I think it will help solve the whole insurance penetration that currently India deals with.
If not fully, definitely partially it will address, and I hope ki with these changes our penetration will increase. And the lower section of the society, they will be able to afford insurance. They will come under the umbrella of insurance cover. Because if you see fully, very honestly, once the breadwinner is not there, probably those section of the society, they are impacted at the highest order.
Correct, yeah, true.
Not similar to any affluent section of the society. So possibly it is being a move which is trying to include them also into the umbrella of insurance, ambit of insurance. And it is more for the social security aspect also, it will be much beneficial, what I believe.
Correct. Got it. Sabya, I think we have covered the draft quite in detail, and it is actually an extensive document. I'll just leave you with this last one question. Are there any other significant changes from the perspective of policyholder that one should know about?
Basically, the framework of this new exposure draft, it is again the earlier product regulation, that is 2019, 2013, etc.
Right.
Yes, some changes have been made and some changes have been suggested actually through this exposure draft. But here I feel the more importance have been given to the policyholders aspects, and directly or indirectly the insurance companies will try to reduce the cost, to reduce the expenses, and to include more and more people of the more section of the society which are otherwise not being considered in such a serious note, or might not have included at all. I think that will increase, and the penetration of insurance definitely will go, and it is a customer friendly manner which is coming here. There several things have been proposed, and we have to just wait and watch ki ultimately in the notification stage how much is coming. And with the new insurance products which will be coming post the regulations are implemented, we are very positively, I am excited to see any positive changes over the market.
Right. I think we'll all wait for the exposure draft comments and then subsequently this becoming a regulation. Thank you, Sabya, and thank you so much for discussing this entire draft in detail and breaking this whole thing for us. I'll let you go now. Thank you for joining us on the Insuring India podcast and also doing it on such short notice.
Thank you, Sabri. Anytime you are most welcome for any such type of.
Thank you so much. We hope you enjoyed this conversation and liked our explainer series under Insuring India podcast. We hope to break things down for you as much as possible and simplify a lot of concepts in our coming episodes. That's all on this episode, folks. Do subscribe to us to keep getting notified whenever we drop something new. Thank you and see you next time.